Hello, I'm Alwyn Gwilt, and this week we welcome Lee Coates, founder of Ethical Investors. Lee founded the Cheltenham-based IFA firm 20 years ago, long before climate change and green were the buzzwords they are today. Hello, Lee. Welcome. Thanks for joining us today.
Good morning.
Ethical investing was barely an idea 20 years ago. How has that landscape shifted over that time period?
I don't think fundamentally ethics have changed over the time period. What's changed is people's acceptance that there is a link between their financial arrangements and their personal beliefs, and that the two don't run separately anymore.
We hear all these keywords like light green, dark green, SRI. Is this all just marketing hype? Isn't something ethical or not?
From an individual investor's perspective, it's very simple. Ethics are ethics. I mean, obviously, each individual has their own definition of ethics. Where you get the different definitions of SRI and green and light green and dark green, that comes more from the industry, who are trying to sort of maneuver their products around to fit their investment philosophy. So if a fund manager wants to have a less ethical fund than another fund, they don't market the fact that they've got a less ethical fund. They say it's light green, medium green, or sustainable or socially responsible. In other words, they are the ones that have coined the phrases, not the investing public.
But how does one draw a line? I mean, if an oil company is investing in greener solutions and a wine grower, for instance, in France is employing an entire village.
Well, very much like beauty, ethics are in the eye of the beholder. So it's really down for the individual to decide where they draw their line in the sand, and that's simply what it's about. Each individual will say an activity is unacceptable up to a point. For some people, the line is drawn right at the beginning. For example, if a Quaker doesn't really negotiate on different degrees of investing in weapons manufacture, they just don't. When it comes to oil companies, it's interesting because we all use oil. So a lot of investors would look for best in class and possibly would balance a company's commitment to renewables with its oil production. So you could say that we're in transition with some oil companies.
Do you think the parameters for investors have changed in this time?
Yeah, I think some of the fundamental principles of this are the same. So it depends on your background. But I think definitions have definitely changed. 20 years ago when I started, human rights was covered by simple avoidance of South Africa and Chile. That was it. As long as you weren't investing in companies trading in South Africa and Chile, human rights issues weren't considered for the rest of the world. Now you have an overarching human rights policy. And it's far more interactive now, so that a company can be trading in an oppressive regime, but if it's providing medical equipment, water and that sort of thing, that's deemed to be acceptable, whereas riot suppression equipment in an oppressive regime, if you put those two together, you know what you're going to get. So they tend to be avoided.
Is all this choice a bit overwhelming for investors? I mean, how does one keep up?
It's probably more difficult at my end as an advisor because I have to be all things to all people. So I have to swap from someone with, if you like, a faith-based version of ethics to an atheist with socially responsible principles, because individuals are driven by their interests. So ethical investors tend to focus on the issues that are of concern to them, because they just need help with translating that to where they should and shouldn't be investing.
Do you think that means that a lot of investors have the wool pulled over their eyes?
Very much so, yeah. Either by the product providers who provide little information about their definition of ethical, or more likely, if an individual seeks advice. You're not going to get ethical advice from a bank. And I don't mean that because necessarily banks are unethical. That's for the individual to decide. But it's more that the vast majority of bank advice is given on bank products. And therefore, even if the bank had access to an ethical fund through either their own investment arm or through their tied arrangement, that's one fund. And as every individual has different ethics and every fund is different, the idea that every individual going to a bank for advice is going to be comfortably matched up with the one ethical fund, it's just not tenable.
The income debate is always rife. Do you think it's income over ethics or the other way around?
generating income from investments. That is difficult within the ethical market. It's certainly better than it was 5 years ago. There are far more corporate bond funds to choose from, and we're aware of a couple of new funds on the horizon which will be geared at equity-based income. So we've got 2 or 3 equity-based income products at the moment, and another 2 or 3 more from good providers would be enough for the ethical market. But at the moment we're in sort of a transition.
The Investment Management Association saw net outflows from ethical funds for the first time in the second quarter of this year. Are investors losing the faith?
People are not changing their ethical values in relation to the current climate. What they may be reconsidering is their exposure to equities. So an ethical investor, if they're reconsidering their exposure to equities and the market in general, are going to pull out the market. Whereas a lot of money in mainstream funds is simply recycled from one fund to another. So people might have been invested in brick funds a couple of years ago. Well, unless they fundamentally change their view on being in the market, they may just decide to come out of brick funds and go for cyclical funds, more traditional sort of recession-proof equity. So money is recycling around the market, but there's not a lot of recycling within the ethical market. The money is in ethical funds or it's not. It's not going to come out of ethical funds and go mainstream.
Over the past 5 years, the FTSE for Good has underperformed both the FTSE All Share and the FTSE 100. Does the performance justify the hype?
I've never been a huge fan of the FTSE for Good index. It's rather than being all things to all people, it's nothing to anybody, in my view. And the reason for that is that its stated objectives from when it was launched was that long-term the fund would have no avoidance criteria. Now, it still avoids some arms, nuclear and tobacco. But as I say, the stated objective is to have no avoidance. So the best nuclear, the best sort of most responsible tobacco and the nicest weapons company is the long-term aim of the fund. So it's not going to appeal to ethical investors. And for mainstream investors that aren't interested in being ethical, what's the point of going for FTSE for Good when you can buy any other equity-based tracker? So I've never really understood the marketing behind the product. It just doesn't exist as far as our clients are concerned.
So is this just the beginning for ethical investment then?
I think because of the interest in climate change, there's going to be increased interest in broader responsible issues. I think the industry is now desperately hanging on to the term responsible and trying to get rid of the term ethical because of its sort of negative connotations. But definitely the interest in climate change and just good capitalism. That's the interesting thing with climate change, is that people don't require an evangelical conversion to environmental concerns. Good capitalism will acknowledge the fact that if climate change is a serious problem, someone's going to make money out of solving it.
Excellent. Thank you so much for joining us today, Lee.